Hedge fund versus private equity fund. Contrasting investment vehicles. Hedge funds and private equity funds are distinct types of investment vehicles that cater to different investor needs, risk appetites, and financial objectives. They operate with varying strategies, structures, and investment horizons, impacting their approach to capital allocation and investor returns. 1. Hedge fund overview. Hedge funds are alternative investment funds managed by professional portfolio managers who employ diverse strategies to generate returns for investors. These strategies may include long-short equity, arbitrage, derivatives trading, and leverage to capitalize on market inefficiencies and price discrepancies. Hedge funds aim to achieve absolute returns regardless of market conditions, using sophisticated risk management techniques to hedge against potential losses. 2. Investment strategy. Hedge funds often engage in active trading and seek to generate alpha, or excess returns above a benchmark index, through tactical asset allocation and market timing. They may invest across various asset classes, including stocks, bonds, currencies, commodities, and derivatives, leveraging both long and short positions to optimize risk-adjusted returns. 3. Investor profile. Hedge funds typically cater to accredited investors and institutional clients seeking higher returns and portfolio diversification beyond traditional investments like stocks and bonds. They offer liquidity options, albeit with potential restrictions, and charge performance fees based on profits generated, aligning fund managers' interests with investor outcomes. 4. Private equity fund overview. Private equity funds pool capital from institutional investors and high-net-worth individuals to invest in privately held companies or buyouts of public companies, aiming to restructure, expand, or improve operational efficiency. Private equity firms take active ownership roles, implementing strategic initiatives to enhance company value and achieve long-term growth objectives. 5. Investment strategy. Private equity funds focus on acquiring controlling or significant minority stakes in companies, often with the intent to facilitate ownership transitions, implement operational improvements, or execute growth strategies. They operate with longer investment horizons, typically 5 to 10 years, aiming to realize capital appreciation upon exit through IPOs, mergers, or acquisitions. 6. Investor profile. Private equity investments are restricted to accredited investors and institutional clients capable of meeting minimum investment thresholds and committing capital for extended periods. Investors benefit from potential higher returns compared to public markets, driven by strategic value creation, operational enhancements, and market timing upon exit. 7. Risk and return. Hedge funds offer liquidity, but with higher volatility and market risk due to aggressive trading strategies and leverage. Private equity funds involve illiquid investments with longer holding periods, offering potential for substantial returns through active management, operational improvements, and successful exits but subject to market and business risks. 8. Regulatory environment. Hedge funds are subject to less regulatory oversight compared to mutual funds, operating under private placement exemptions and reporting requirements. Private equity funds adhere to regulatory guidelines governing investment disclosures, fund structures, and investor protections to ensure compliance with securities laws and industry standards. Conclusion. Hedge funds and private equity funds represent distinct investment strategies within the alternative investment landscape, catering to different investor profiles, risk appetites, and financial objectives. Hedge funds pursue absolute returns through active trading and market strategies, appealing to investors seeking portfolio diversification and potential alpha generation. Private equity funds focus on long-term value creation through strategic investments in privately held companies, offering potential for significant capital appreciation and operational improvements over extended investment horizons. Understanding the differences between hedge funds and private equity funds helps investors evaluate alternative investment opportunities, assess risk-return profiles, and align investment strategies with long-term financial goals and market conditions.